Hello, welcome to this podcast. And today's podcast, I'm going to be talking to two leading VC investors who specialize in early stage investments. And delighted to have the two of them here. I have Rainer Christine, the managing partner from Early Bird Venture Capital, and also Joey Mason, partner at Duplex Capital Partners. So welcome, gents. Thank you very much for joining us today. So we're going to do a bit of a master class, if you like, for people that are listening or watching this, to really get a feel for what it's like for a CEO to be looking at finding investment and then what they really need to be doing to really grab the attention of people like yourself and other investors. So I thought a good question perhaps to kick off would be, if you were to imagine that we have a CEO of perhaps a digital healthcare company, for example, which I know is one of the areas of interest for both of you. How do I get your attention? I mean, Rainer, do you want to... and the other interesting thing, in fact, about both of you, which I must mention to the listener, is that both of these gentlemen have both been CEOs themselves of healthcare technology companies and life sciences. So they have a unique perspective in that regard. So, Rainer, perhaps if you could, cast your mind back to when you were a CEO of an early stage company, how did you get people's attention in order to get that investment?
Yeah, very good question. I think maybe one very practical aspect. I think it's always easiest to get an investor's attention if you get an introduction from the network. So to end up, via a cold call on an investor's desk has a much lower chance of success as compared to the situation where kind of a friend from the network makes an introduction. But that's sometimes a lot harder to do than talking about it. And generally speaking, what's interesting to investors, I think it's always a combination of product, market, and team mostly. And I'm stating the obvious here, but I think it's absolutely worth the time for any founder, any CEO to think about the fit they may have with this particular investment firm. So it makes a lot of sense to dedicate a bit of time to really understand as much as you can from the outside, from the website, from your network, what the investor is about. What are they really interested in? Because you're just wasting your time if you're kind of speaking with the wrong type of investor. But this said, since you talked about digital health companies, not necessarily easy, because it's a relatively new aspect of the industry. And you have a selection of, is this more about life sciences? Is it more about tech? Which funds are actually venturing into that convergence zone of data and healthcare? So I know a very wishy-washy answer, but I think doing a little bit of homework before reaching out, I think, is super advisable.
No, that's a great tip as well, looking at that alignment, really. What about you, Joey? I mean, you when you were a CEO, what did you do initially to get the attention of the guys that you wanted the investment from?
I guess if I'm just thinking about what you're selling, as in shares in your company, I think you have to, the clearer you are in your own mind about what the market opportunity is, what the product can do, the qualities that Rainer mentioned, talk about your team. But I would say initially, investment funds, fund managers like us, we essentially sell money. And for that, we buy shares. And so you're on the other side of that trade. You're selling shares to buy money. And so on the one hand, you have, exactly as Rainer mentioned, you have to understand what the buyer wants. So know your customer. That's really important. But I think you also have to be able to really well articulate what you are doing, what you're offering. Why will this be an interesting company to anybody? And I kind of boil it down to, fear and greed. You have to be able to elicit significant greed in the eyes or ears of the investor. They have to say, like, every sentence you're speaking, oh yeah, this is really interesting. This is a huge problem you're addressing. The market's growing at a rate of knots. This is the team that can do it. It's the product. I mean, all those things that are basically the bits that allow the conversation to go on. And if you're thinking of the objective of a meeting is to have the next meeting, i.e. you hook somebody. So I think if you can be very articulate on what the opportunity is, not necessarily, don't oversell technology. Investors see technology all the time. That's not really what they're trying to elicit. It's like, is this opportunity very significant, and is it the right timing? So if I'm back in those shoes, it's putting my company in the context of this market that is either ready to explode, is exploding, etc. Something that can really get people hooked on why I'm doing it, which is my own personal investment and I'm spending my life doing it, to why they should be participating in it.
And I suppose in a sense the opposite of those things might be the case in answer to the question I'm about to ask. But what do you see regularly mistakes that people make? When people are pitching to you, and I suppose particularly for early stage investment, this is going to be the case, isn't it? Because often the CEOs might be scientists, or they might be engineers or doctors, maybe. What things do they get wrong, which would be so easy for them to get right, if you like?
Yeah, I think from my perspective, Joey already alluded to one of the key things we often see is too much of a focus on technology rather than a product, rather than a solution for the market. Of course, it tends to be a mix. I mean, usually founders in our space are originally scientists by training. So, of course, they come from the technology space. But, of course, to be interesting for an investor, you need to come to the stage of really understanding what the market need is that you're addressing. And of course, technology will play a role, and often a key role, but you really need to be super clear on what's really the product, what's the market need that's unaddressed, that you can help solve, and what's different about your company as compared to other companies, other technologies. So I think the right balance between a kind of a commercial solution, including technology, of course, but certainly not limited technology, and the bigger picture, as in and the way Joe described it, I think is very suitable. I.e., how's the investor going to make money with your company? I think that's a key concern. And of course, as a scientific founder myself, that was not necessarily the way we were thinking about our first product, our first solution, but actually, looking back 25 years, the first business plan that we put together wasn't all that bad, even by today's standards. So again, it makes a lot of sense to think through those questions. And maybe one other side comment, because I guess we're all assuming venture capital is the best possible solution for the companies we're talking about. That may well be the case. It may well not be the case. So I think it's an interesting question to answer up front. Is venture capital even the right tool for my company, for my idea, for my project, or is it something else? I think venture capital is not necessarily always the best solution. Very much depends on what you want to do.
I agree completely with Rainer on that. I guess the number of companies who they come out of an incubator, an accelerator, and they default to getting venture and are looking for venture. And venture is very rare. 99 point, I don't know how many percent of the world's companies get by just fine without venture. Thank you very much. And if you think about the why, and this is where I kind of think of being in the market that's expanding is critical. I kind of think of venture as basically 35% interest rate compounded per annum. That's the price. And if you're thinking about that, very few companies can grow consistently at those kinds of rates by self propulsion. And so you have to be in a market that is expanding itself rapidly to allow you as a company to grow. And so it kind of feeds in. We're looking for growth. We're looking for, is this, we're buying growth, and is the timing right? And if you talk about things like digital marketing or digital companies, for example, getting the timing right is actually really difficult. We can all see companies where, as Ryan mentioned, the technology is interesting. It's addressing a problem, but the question is, can it scale? And can it scale with no matter how much money you put into it? Because medicine is conservative. Health is an inherently conservative business, and no matter how much money you have as a VC, you can't make a market. That just isn't possible. So you have to be timing the funding for a specific company to meet a market need, and you can't be the first to the market, because then you have all the arrows in your back, classic stuff. So when I'm thinking of I certainly made the mistake when I was doing it as a founder. We basically figure, we didn't get our timing anywhere near as well as I might have. And certainly in retrospect, that's something I would be harder on myself. And getting a little bit of traction is fantastic. If you've got a client that tells you, you're solving a problem for them, the question, and which we would see again, a lot of companies, and I think this is where a lot of founders get that early incentive to, keep pushing here, to really examine, am I just seeing a complete bluebird? We've got one customer and we're solving their problem, or are we actually addressing a really country or global question, and have the solution for that? And they're hard questions. They're not easy ones to answer.
So let's look at the market piece then. So being able to have an instinct, obviously, is all very well for the direction a market is going. But imagine, we have this founder who is an engineer, and she or he has developed this. What advice would you have for them in terms of analysing whether their instinct that there is a market for this is actually there, and it has that kind of growth potential, that scalability that you talked about? How do they assess that? What's the most straightforward way to actually kind of, engineers, for example, they're used to sort of destructively testing things, aren't they? They've set out a hypothesis, and then they have to see whether they can knock it down again. So how do they do that with respect to marketing? And very often they'll probably know very little about that.
Yeah, I think it's not always a trivial exercise, but generally speaking, it's super important to really speak with an open mind with your potential customers, and don't assume you know what the market wants. You probably have a good idea, maybe not. It's super important to really speak with customers and to really understand what they really need, and not just with one or two, but several, and maybe customers that you don't feel comfortable with initially. I think it's very important to get out of your comfort zone as a scientist, as an engineer, and really start understanding the commercial piece. Maybe that requires, adding somebody to your team, working with a consultant. But in my experience, there's nothing like doing it yourself. You really, as a founder, have to go out there and speak with your target audience and understand whether, what you're working on is even of interest to them, and not only of interest, but would they be willing to pay for this eventually, is also quite an interesting question, because for people to try things out, if it doesn't cost anything, is a very different story from commercial validity and, as Joey pointed out, scalability, which is an entirely different beast. As in, okay, what could margins potentially look like? How could you get this to a high growth rate? Super non-trivial questions, but I think as a founder, you simply have to get your arms around this, and it's not about perfect answers. It's about developing kind of work in progress. It's about developing an understanding, and good investors are definitely there to help with that, but they certainly would expect kind of a basic level of commercial savvy on the team. And maybe a quick side note, and I think it's maybe important to have that level of self-criticism here. As a founder, be ready for a certain level of complacency in the investor community. Maybe that's a way of putting it. There definitely is in Europe. I think we're looking at a fairly pathological ecosystem, i.e., lots of ideas, projects, startups, IPs, lots of things to select from as an investor. But actually, what would be good is to not have money as the bottleneck, but to have the good entrepreneurs and the good projects as the bottleneck. And that, unfortunately, is not the situation. So a piece of, I think, important advice to founders is don't get frustrated too easily with investors who haven't done their homework, who aren't all that smart as they potentially claim. And of course, we all claim that. And I think that's something, be ready for having to do some unexpected communication, for getting people up the learning curve. And I'm not saying that's the way it should be. I'm just, I'm afraid that that is the way it is frequently, in particular in Europe. So be ready for sometimes less than professional interaction. And I think I'm saying that with a good dash of self-criticism.
I think that's an entirely reasonable, Ryder. And by the way, I'm not so sure about Europe being the only. Yes, I think it's a venture thing. But yeah, I mean, what was I thinking on the customer feedback? It's critical. If you don't have anyone telling you that this is an interesting product, service, whatever, a third party, then essentially you're potentially fooling yourself. So I think I can only agree with what Reiner's saying. There's another angle that I think I'd certainly have seen over the years, where founders were very reluctant to talk to the market for fear that somebody would steal their IP. And if that is your problem, then you really have a problem. If somebody can steal your idea after a conversation, and you haven't done, you've essentially got nothing. I mean, it's like, your child could come up with the same idea. It's just you don't have IP, right? So ultimately, we're all in a chain of essentially ownership, and if we buy shares from a company today, we're going to want to sell them in 5, 7, 10, whatever years next year. But we will want to sell them. And so the company is going to be sold either to another company or on the stock market. So you've got to have that exit. And if it is absolutely vital to understand, what does the market think about your product, your service, where will it fit? And the sooner I worked in a corporate VC, and I can tell you, the job of BD is to figure out what's going on out there in the big bad world. And they want to talk to companies as early as possible to get a sense of where might they fit in a roadmap. And I'd always advise entrepreneurs now, talk to the market, talk to the companies, talk to the BD folks. It'll be mixed. It'll be like talking to investors. Some will be good, some won't. But you'll get a sense of, okay, yeah, if I do X, Y, and Z, I'm now on that roadmap on that company in 3 years' time.
So you're talking about sorry to interrupt, Joey, just to clarify there, you're talking about the BD people, the business development people, say, within a corporate company rather than within the venture community. Is that what you're saying?
Well, it's a variation of what Reiner was saying, is talk to the customers. So right. if I know who my customer base is, and it is a bunch of pharmaceutical companies or a bunch of doctors, I need to understand what that customer base is saying about my product, right? The next bit is, if I succeed, where do I end up? Where does the company end up? And the sooner you have a picture of that, the more you can articulate to your own and the investors, because as I say, the first question they'll ask is, what's the exit, right? It's like, how am I getting out? And you're there, I haven't even started. But you have to think of the end of the journey. Where is it all going to? And it's part of that research that Reiner mentioned. The more you've done at the beginning, before. Even the answers won't be perfect. Nobody expects perfection, but they do want to have seen you've started to do it. It's a bit like having, you can absolutely present your team deck or team slide, which has a bunch of blanks to be filled. But if I've seen that you've identified 3 roles out of 7 or 5 or whatever that need to be filled, at least I know you're thinking about it. And you're not saying, we're the 2 people that are going to run the, global domination. It's like,
Yeah. Yeah, and what about? I mean, the sort of connected to that is focus, because one of the things which I've seen with early stage companies I've been dealing with over the years is, and let me give you some examples. Things like diagnostics, and I think the same will apply to digital health. Is hey, we've got this diagnostic where we can treat, or sorry, we can diagnose, 20 different pathologies, and let's go for all of them, because that'll mean that's going to look good. And we know, of course, that's not a good idea, but because also it dilutes your funds and everything else. How do you? I mean, this probably goes back to your background, Rainer. How do you decide? Which of these 10 different things that I can potentially do with this product, how do you decide which one of those 10 you're going to focus on first?
Yeah, maybe 2 aspects to this. I mean, let's maybe start with some of the typical investor views. I guess no matter how you do it, you can always get criticized violently for being either a one-trick pony,
right,
or not having any focus at all. So no matter what you do, it can always be perceived as wrong. So very important to develop your own conviction, and investors know a lot less about your product, your company, and they never will know nearly as much about your product, your company, your market as you hopefully do, or will at least strive to learn. And so I think that the question of focus again is very much related to the customer, i.e., what's the most urgent need? What is the largest market? What's the development hurdle? So I think it's a question. It's about the right balance of how many resources do I need to put in to get to a certain product, and how well can I sell it? What's the revenue upside there? So there is not an easy answer to this, but I think it's very important for founders to develop their own well-founded opinion about this. So it's less about an opinion. It's really about gathering data and really developing an understanding of the market, and what's the input, what's the output. And I think just to tag on a thought to some of our prior discussion here, I think in terms of understanding the market, that's usually outside of the comfort zone for most founders that are scientists, technologists. But the same goes for a lot of the other aspects of building a company. So while, let's assume you're great at technology, otherwise you wouldn't be a scientific founder. I guess the objective here is to be just as great in any other aspect of the company, whether it's the commercial piece, whether it's IP, if that's relevant, whether it's strange things like manufacturing, quality assurance, or if you start sending stuff throughout the world, logistics, all of that feels unfamiliar, and all of that needs to be done extremely well, because any startup, I guess, is very, very little tolerant to big mistakes. Unlike big companies, they can kind of underperform for quite a while and still survive. You simply can't do that as a startup. So the hurdle is very high to be successful, and you need to be really quite good in everything you're doing. So that was a little side note, but I thought that was maybe.
No, I agree, Rainer. You actually, Nigel, it's funny you mentioned diagnostics. It's a bit of a bugbear of mine. I worked for a diagnostics company in the 90s. That's a last century, very last century. But we had a chair in one of our businesses who had launched products through, 2 companies, Istat and Nanopore. Not Nanopore, and we'd have been approached all the time when I was, in my old firm for diagnostics companies looking for money. And Bill had this expression: you can't. It was an aphorism. You can't launch a diagnostics company for less than $100 million. And that was in 2005. So it hasn't got cheaper. But for me, it was really helpful because it's to that point, we can put out 10 tests, 20 tests on a platform. I'm not so exercised about which specific test. Reiner's done it exactly, where's the most market need, all that kind of stuff. But are you kidding yourself about how much it's going to cost? Diagnostics have this delusion that, you can save your way into a large market opportunity by spending a few million here and a few million there. And the actual number is way higher to get to the market. And that's the bit I think that you, as an investor, you would really test. It's similar in digital health. I had a company there today talking to me about a certain market. And as I was pushing them along, all the money that they were going to raise, they had a product, they had a platform, it was working perfectly well, but they then needs to get customers. So it's like, okay, so your entire money is going to go to Google and Facebook and Instagram and TikTok because you have to attract customers. So what's that number? And in fairness, they didn't know what it was, but that's fine. There's nothing wrong with that. But in my head, I'm thinking that's tens, if not hundreds of millions of dollars to buy customers. And so the money is the same. It's where it's deployed might be different. Here, in that instance, it's, in social marketing or social media. In the other one, it could well be regulatory, upscaling manufacturing, launching at in a per country. But it's for the founder to have some sense and tested it about how long is the journey and how much will it cost. And if they have a sense of that, then you can have an engagement with your investors, because it's going to be an opinion, and somebody may have strong opinions, pro, con, whatever. But at least you're beginning to understand what journey am I on, and if you're on an expensive journey, the prize needs to be huge.
Yeah.
And again, it all feeds into the fear and greed, right? But if the penny drops that you're not on a 2 million funding journey, you're actually on a 50 million or 100, then everybody's going to say, okay, this has got to be worth $1 billion or more. But it forces you as a founder and as the scientist, it doesn't matter what your background is, like, is this worth it? Is it really worth it? And we think in pounds, shillings, and pence and old money, right? So what is the number? And I think the more you've thought about that, the more you can handle objections. You can find those investors who buy into the vision over time.
Yeah, very good. And in terms of just going back to the process, so again, imagining that one is an early stage CEO, thinking about how they go through this funding. Both of you, I think, are more focused on the early stage investment. Could you talk the listener through who may not have experienced this so far, how those rounds of investment work? And I mean, I'm sure there's huge variation between different individual cases, but in terms of just a general talk through, if you could, one of you, Rainer, perhaps just talk the listener through, if you could, how that works.
Yeah, like you already said, there's a lot of heterogeneity, but I guess typically, let's maybe look at a university spin out of sorts. I mean, usually kind of the pre-seed phase is some sort of combination of, grants and university associated or location associated money. That's maybe the pre-seed stage. And then if you're able to attract kind of good seed investors, they're already maybe, institutional capital that really can add value beyond your region of origin, so to speak. And I think for the very attractive companies, I think that's a good part of the journey. And I think the key question for any financing round is, okay, what are you going to achieve with the current capital that is going to enable the next round? And I think that is super, super important and very much underrated by most founders who don't have the experience yet. So what am I going to do with that first $1 million of pre-seed money, or the 3 million of seed money, or the 10 million of Series A money? Of course, the numbers can be very different, to enable the next round, and not in the sense that I'm running out of money in December and I have my value inflection point in November, so I have 4 weeks to raise the next round. That's not going to work, depending on the markets. And of course, at the moment, they're really difficult. You need to have enough time after you've reached your value inflection point to really raise funds. So I think this is actually, it's a bit of an art. It's no less difficult than great science, to be honest with you. It is really, an art of its own to do that well, to raise money well, to sell your company well, to interact with investors well, is not trivial, and is not anybody's cup of tea, honestly, and it doesn't have to be. Is every scientific founder the best person to do investor relations, to do fundraising? Sometimes yes, sometimes no. I think the main thing from an investor perspective is the team needs to kind of tick the boxes and not necessarily the individual. But I think that it requires a lot more planning and a lot more diligence and attention to the fundraising journey than maybe the typical scientific founder without experience would imagine. It's quite a ride. And I guess in football, the rule is after the game is before the game. And I think that's super true here. You kind of never leave that fundraising mentality, because that's a key concern. If the company runs out of money, it's dead. So that's something you must absolutely make sure of, is the company must not run out of money. And that requires a lot of attention to that. So that was a bit of a general answer, but I think that
so if you're early stage investors like yourselves, when do you bail out, and when does I know again we're talking in generality here, but when do you say, right, okay, that's no longer our level of interest, and then a different type of investor takes over?
Sure. I think, Nigel, I'd certainly think about it in terms of, okay, so the fund we're raising at the moment, looking to raise 150 million euro. We're going to call it 8 to 10 million in a company over time. Early stage, 2 to 3 million, later stage, 6 or 7 million. What we would want, we need to be able to buy a reasonable stake in the business. So that will help, for us, it's going to get a financial return. And I think in terms of how we think of passing on the baton, we never pass the baton on financially, because, if you can't write the last check, you're in trouble as an investor. So you always have to be able to write a check. And you certainly can't rely on the kindness of strangers to look after you. So we kind of have that paranoia built into us. But in terms of, helping to bring the company along, I'd ask the question, how many venture folks do you need on a board? Probably less than one, So, when are you helping? You really are helping when you're raising money with a company, when you're making introductions to your network. Could be advisors, it could be corporates, it could be BD folks, whatever. That's when you're being helpful. And after that, I kind of have a view, the less is better. The best run companies don't need help from most venture folks. They do need it when they know when they need it, and you can get involved. But passing on to larger investors, if you're raising 20, 30, 40 million in a round, what's 2 million going to do for that? It's not a significant, it can't have a significant impact on the investment. And you're kind of passing the baton along at that stage. As I say, as a fiduciary duty to my own investors, to our LPs, we absolutely have to have a visibility of what's going on in our investment. But that's separate, really. That's a kind of, call it, governance thing. And we will want to continue to support the company. But if we can't add value at board level, then it's, you actually are. So in some cases, you're not needed from day one. In other cases, you step off after a number of years, or you step back. So that's the way I'd look at it. And you want to literally pass on to people who are better than you, know more. Humility does help. There's always people who know more, or who are better, are in the right place, right time. Be prepared to take that out.
You've both touched on this in the last couple of minutes, and obviously it's my area of interest, the team side of things. I've seen businesses over the years, and obviously wouldn't name any names, and you think, gosh, that isn't exactly a very diverse board. And I don't mean diverse from an HR point of view. I mean just in terms of skill set. Sometimes with early stage companies, it can be, the founder and the founder's mate or a family member or something. How do you view that, and how important, is in terms of doing due diligence for your own investments? Do you look very deeply into those other members of the organization? And if you do, what are you looking for?
Yeah, I think as far as the key members of the team are concerned, we take a very good look, because as an early stage investor, that is kind of the key element you're investing in. You're investing into people probably more than you're investing into a technology platform, IP, whatever. I think all of that, of course, needs to be there as well. But fundamentally, in early stages, you're really investing in people. And you're investing in people who are already there, and you're investing in people who aren't quite there yet. So there's also a question of how open is the founding team to making good additions. And in my experience, it is so much better for the founding team to drive that, rather, as compared to the situation when investors start stuffing things down your throat in terms of you must add a chief commercial officer. Now, when it's come to that point, that's already actually suboptimal. And actually, just from my own experience, when we hired our CFO, actually, somebody I kind of convinced to leave Deutsche Bank at the time, a 90,000 people company, and join this 20 people startup. My investors were saying, you don't need a CFO now. I said, no, I don't need him right now. That's true. But I will need him very soon. And if I don't do this now, it's simply not going to work. And we will simply not be going to be able to grow the way we want. And that was true for our CFO, and that was true for our head of marketing and sales. So I think it's super important to really build this team without too much ego involved, and to be keenly aware of what you don't bring to the table as a founder. And that's always lots of stuff, because no single person can run a company in a perfect way. To kind of, so really to complement the team, and not waiting around until your investors start begging you. If you've come to that phase, something has already gone in a suboptimal fashion, I would say.
I completely agree, Reiner. If I'm thinking of the best teams that I've backed or have been lucky enough to be investors in the companies, they from the word go, they were always bringing better and better people. If that doesn't sound like a contradiction, they built an A team, and it could be the advisors that you have. I mean, as Rainer said, when you're raising money, I mean, venture is the last place you go. I mean, really, if you can get money from anywhere else, it's going to be a hell of a lot easier than venture. But if you're choosing venture, build an environment that is, the strong company that you keep. If you've got excellent people working with you, advising with you, and a lot of people will do so for free for startups. They're not expecting anything, because they're just going to help out. You can get a lot of assistance there. But as a team, if you plan to be excellent, you will be able to convince people who are in higher paying jobs, in established roles, you can sell the vision to them as to why it's in their interest to be part of what you're building as a team. And I can think of the various companies that have excelled at that, and they just consistently brought on strong people, and more to the point, they had enough. What's the word? I guess self-understanding, self-awareness, that if things weren't working out, they changed very fast. So very slow to hire, very fast to fire.
I mean,
If it wasn't working, it wasn't going to get better.
The thing I find fascinating with this, and it's in my view, it's probably one of the easiest. I know it's my own personal interest, but it is one of those areas where it's an easy win for early stage companies, because this is probably the most easy demand planning they can do. They've got to figure out who they're going to need to align with their business plan, haven't they? And if they can work out who they're going to need to align with their business plan, then they put that process in place to say, this is how long, I'm plugging here, but please speak to me if anybody's thinking about this. You can work out how long it will take you to actually undergo a process to find anyone, and you can put certain tolerances in that. So then that, like in Reiner's example, you know that at some point you're going to need a chief financial officer, well, start thinking about it now, because it might take you a little while to actually achieve that. And at the point at which you're able to appoint that individual, and she or he has been through their notice period and they're there, then you're already at that point where you actually do need them. That's a lot better situation to find yourself in as a business than thinking, hey, we should have had a CFO 6 months ago, and we really need that person to help us with, positioning ourselves for the next round of funding or whatever else it is. And now we start, and then we could take another 6 months to do a process. We've got 12 months of lost time. So yeah, it's an easy win.
Yeah. And by the way, I would think sorry, Reiner, just you've talked about execs, Nigel, and I completely support it. I mean, the building out the team, thinking about it, planning it, absolutely. This is an observation. I think in the UK in particular, both investors and companies put a very strong emphasis on the board. And I actually think that that's nuts. You're essentially asking an exec chairman or independent directors to play a role that, is just impossible. And there's a reliance placed on these people, which is completely misplaced. And that, I think, really affects the balance at board. It affects the balance at management level as well. As far as I'm concerned, the board, okay, it oversees management, but it's really management. You've invested, you are backing management, and you want to see a strong, developed, healthy, collaborative, all the right words of, a highly functioning management team, and the board will sort out itself. It's not that it's unimportant, but it's nowhere near as important as I think a lot of founders make out, or are led to believe, because they wouldn't just invent it.
Sorry, I should have clarified. You clarified my point really helpfully there, Joey, because I agree. It's going to be the people that do in the end, isn't it? That mean that whether or not, and it will often be those people that do that management level, whether that's a production person or regulatory or whatever it is, it's going to be those people that enable that overall vision to be delivered. So yeah, thank you for clarifying that. Very good. Any other, before we wrap up, because we're trying to get this within 3/4 of an hour, any other, let's choose you first, Joey, top tips for anybody who is about to embark on, looking to get investment? What would you say? What are your top couple of things that you would advise them?
Apart from all the preparation, which I think we've talked about, I just be prepared for a long process. It's 6 to 9 months. You're kissing a lot of frogs. It is a numbers game. Most funds will invest 1 or 2 in 100. So just do the math and turn it around and say, okay, I need to talk to 100 investors, but don't be disheartened by it. And as an operator on the venture side, I would suggest to people, say, look, if somebody hasn't said yes, it's no. If they're not giving you the right feedback that we're interested in your business and we want to learn more, the answer is no. Venture folks find it impossible to say no. They'll say no in 1,000 ways and never use the word. So if they're not saying yes, the answer is no. and move on.
Yeah, I totally agree with that. Maybe one additional aspect, I think what remains super important basically for any human activity, certainly for setting up a company, because it's so much work. If you can't do it with passion, if you don't love it, don't do it. I think that is key. If it's not fun, if it doesn't make you jump out of bed in the morning with a big fat smile on your face, probably go do something else. It's a ton of work, and life's too short to do something that you find somehow not quite the right fit for yourself. So I think that is key, and some of that gets lost in all of this, relating to investors and all the nitty-gritty stuff and all the frustration. That's all part of it. But if the fun stuff, the passionate stuff, the stuff that you can love doesn't prevail, then maybe it's better to do something else.
What a great point to finish on. I think that any any successful business person, in fact, actually probably some less successful ones who realize they didn't have that passion probably can understand that. I think is a really good philosophical point for us to finish off on. So Joey and Rainer, thank you so much. People who are listening and watching may also be interested to know that we are planning, the three of us, and probably bring a couple of other people into a seminar which we will be holding in London early next year. So I hope that people will be interested in that, and we'll go into some things we've talked about today in some more depth, and hopefully make it as entertaining as these two gentlemen have. So thank you so much to both of you. And looking forward to catching up for either another one of these discussions and perhaps the seminar in the early new year. So thanks so much again. Thank you for listening or watching this podcast. Our guests today were Rainer Christine, Managing Partner of Early Bird Venture Capital, and Joey Mason, Partner at Duplex Capital Partners. Both can be found on LinkedIn and their respective websites. More podcasts in this series can be found on the Remtech Talent website and also most podcast platforms under The Job Podcast. I hope you've enjoyed this podcast and have a great day.